So my name is Andrew Buglass. I've been lending to or investing in the energy sector since the early 1990s. And during that time I've worked for a number of development companies bringing forward investment into energy projects and also provided debt to the sector for a variety of banks. Most recently I was leading the RBS energy finance team here in London, and I left that at the end of 2014 to set up a consultancy practice which focuses primarily on advising smaller companies on development and strategic matters relating to their investments. I've also had a particularly strong focus on emerging markets during that time. I spent about 10 years living and working in Southeast Asia, and that interest in the emerging markets has continued to this day through a role on the board of a sub-Saharan African power distribution company, which is a listed company going through some very significant changes, which makes it a very exciting place to be at the moment. So electricity is a very unusual asset class in many ways. It has a lot of features which make it very attractive to investors. Particularly, it's obviously very central to any economy of whichever country you're investing in. And as a result, it tends to be highly regulated. That's both a blessing to the investor if the regulation is done well, because the regulatory underpinning can protect the cash flows and the stability of those cash flows. Conversely, of course, it can also be a bit of a curse in that sudden or unpredictable changes to regulation can actually bring out very negative consequences for the investment. Another key feature for an electricity sector investment is that the sums of money involved are typically very, very large. This allows investors to deploy a lot of capital quite efficiently for the long term, which for many investors is a very, very attractive feature of the sector. The energy sector sees a very, very broad range of different types of investor, both debt and equity. And one of the best ways to assess them is by their tolerance for risk. If you think of a spectrum of risk tolerance, at one end of that spectrum you should have debt providers, banks typically, but other providers as well. The best case for them is that they get their money back on time. Anything else is worse and means that they're taking a loss. So that characterizes a very conservative, cautious approach to the investment process. On the other end of the spectrum, you have equity investors who are paid to accept a greater level of risk. They benefit from upside in the project, so that if the project outperforms, they will do better. So they have a much more risk-tolerant approach. But even within the category of equity, there is a huge diversity of investors. Typically, you might see pension fund type investors who are paid fundamentally to protect the money that they're looking after for their policyholders. That means that they need to take a long-term approach and they need to be quite cautious to protect the return and the safety of that capital. Further down the risk spectrum, you will see more aggressive investors who are seeking higher yields and therefore by definition will accept a higher level of risk and volatility on their investment. So investors fundamentally are looking, when they price risk, to reference some known benchmark, some investment which they have made previously or a type of investment which is familiar. What they then do is they will try and extrapolate from that the key features in the new investment which is proposed and assess whether that means that they are taking greater or lower levels of risk than they have done on the benchmark. That then means that they can refer to the price that they used for the previous benchmark, and they can set their cost of capital appropriately. Investors use something called a hurdle rate, typically, which is composed of the underlying cost of their own capital plus a premium which relates to the perceived riskiness of the investment. So the best way of looking at this is to say that investors fundamentally are trying to pull everything back to the known benchmark and then adding or subtracting a return level in order to compensate for the additional risk on the new investment which is being undertaken. However, having arrived at that theoretically correct level of return for the given investment, we also have to remember that all investors are operating in a marketplace where capital is either more abundant or more scarce. And of course the pricing of the capital varies dramatically to take account of that. And as an example, at the moment we are seeing very, very dramatic competition particularly for operational renewable assets in Europe. And when you talk to investors, many of them are lamenting the fact that at the moment the cost of providing equity to those projects is dramatically lower than it was, say, 5 or 10 years previously. And that's purely a function of the greater availability of capital. There is more money competing to buy into a smaller number of projects. So you have the theoretical, but you also have the real market-driven approach. And pricing risk is fundamentally a blend of the two. It's part science and part art. Both risk and reward are changing dramatically and rapidly as the renewable sector matures. On the risk side, it's changing rapidly as a result of a combination of factors, and there's a huge number of those, but fundamentally it's technology driven. We have ever cheaper renewables being deployed in many or most electricity systems, which has the benefit of bringing in lower cost decarbonised generation in a way that would have been unthinkable probably 10 years ago. As the renewable industry matures, both risk and return are changing, and they are both changing very, very rapidly. On the risk side, we're seeing an emergence of much greater quantity of lower cost renewable electricity feeding into the grid in ways that were not considered possible 10, 15 years ago. If you think back to the classic grid structure of the 1960s or 1970s, you had large centrally dispatched power stations controlled by one system operator. Now we have many, many more generation units, and the prevalence of lower cost software solutions allows those to interact in ways that would not have been possible even 5 years ago. That is leading to greater flexibility on the system, but it's also leading to much greater volatility in terms of the cash flows that investors can expect. Renewable energy projects are becoming much more familiar to investors, and indeed the underlying technological risk in most cases has reduced quite significantly from the early days. At the same time, the revenue risks relating to those projects is in many cases increasing. We are now seeing a move in most developed jurisdictions away from the predictable feed-in tariff structure to a situation where projects have to rely much more heavily on traded revenues. They are merchant in nature, and that leads to far greater volatility, a much more short-term nature of the cash flows, and also, by definition, a move away from that long-term predictability which investors were originally seeking in the sector. Returns, meanwhile, are under pressure in the opposite direction. There is a considerable competition among providers of capital currently for attractive projects, and this is putting pressure on returns, driving them much lower than we would have seen perhaps 5 years ago. And I think there's a great example of that in offshore wind, where arguably, unlike many of the other renewables technologies, we are actually seeing technological risk starting to increase as the projects go out into deeper water and use ever larger turbines. Perversely, however, a lot of the investors who were active in the sector, let's say 5 years ago, are now being forced to accept lower levels of return at exactly the same time as they are actually taking arguably greater risks on those projects. And that is purely a function of the pressures, the competitive pressures on cost of capital. So in summary, it has to be said that this is arguably a very good time to be raising money for projects, and a much less great time if you're providing capital for them. So when investors are assessing any particular jurisdiction, one of the key things that they look at is regulatory risk. And principally this is because this is one of the hardest things for an investor to manage. An investor can mitigate, can manage technological risk, they can to some extent manage commodity price risk, and all of the other fundamental risks within a project are, at least to some extent, within the control of an investor. Regulatory risk, on the other hand, is not, and that's what makes it particularly special. Given that the electricity sector is one that tends to be highly regulated, and it's a very complex sector, and that the investments have such long lifetimes, the risk of an adverse change to policy or regulation is very, very significant. So the key things, I would argue, for an investor from a policy perspective are transparency, predictability, and durability. Transparency of policy is very, very important. As an investor, you want to have the feeling that the policymakers are making decisions in a fact-based way. They're doing so in an open and neutral manner, and that they're not being driven by any particular hidden agendas or by lobbying from one particular piece of the sector. So that transparency is absolutely critical. Predictability of regulatory policy is clearly also very important for an investor. We understand and we accept that regulations need to evolve as the underlying sector does. But from an investor's point of view, it is critical that that be done in a way that allows them to manage those risks and to be aware of the transition as it's happening, rather than to be hit with a retroactive change. And we've seen earlier in the post-financial crisis time examples of some European countries which introduced huge retroactive changes to feed-in tariff levels, for instance, leading to very, very significant asset write-offs. Other countries which have done actually arguably very well in managing this predictability point, one could take the example of Germany, which announced in advance how they were going to reduce the feed-in tariff levels so that investors were fully aware and could plan accordingly. And finally, durability is an equally important concept to any regulatory underpinning. Durability essentially is about knowing or having confidence that your investment will be subject to broadly the same regulatory construct through its life as it is on the day that you make the investment. Since assets in the energy sector tend to have very long lives, the impact of a change during the life of an investment can be very significant, and thus the durability of the underlying policy is absolutely critical to investors as they consider which jurisdictions they find most attractive in which to place their money.